Too many people associate retirement with the end.
I figure it'll be a little bit of a transition to try to slow down a little bit.
The number one question I have about retirement is having enough money to last.
In my mind, you start to look at it, that's an opportunity to do more of the things you want when you want to do it.
Make it financially able to do things that I enjoy.
Party.
Just financial security and enjoy my family.
More people need to go into it with their eyes wide open, understanding what is my plan, what do I want to do, and then how am I going to get there?
Will the rules change?
I have no real specific plan.
I'm planning for what the status is right now. I just hope it doesn't change drastically.
Welcome to the Retire-tastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. In retirement, it's all about income. And today, you'll hear ideas, concepts, and strategies designed specifically to generate reliable retirement income. Now, here's the host of the Retire-tastic Show, Joanne Regan.
Hello, everyone. Today we're going to be talking about annuities. That's right, Annuities 101. And there is so much confusion on the concept and the background on the word annuity, so I really want to give you a little bit of history. So honestly, if you were to line up about 10 people, more than half would think that annuities are bad. Most people think that an annuity is a single type of investment, and they don't know that there are different types of annuities. And I know one thing for sure, Ken Fisher does not like them. Now, I do work with annuities, and I also know for a fact that there are bad ones out there, but there are also very good ones that could work for you in your retirement. So before you hit that button to change to another radio station saying, oh my gosh, another person selling annuities on the radio, well, guess what? I'm not here to sell annuities today. I'm here to educate you on the possibilities of annuities and letting you know the goods and the bads about them. I assure you, there are many, many people out there today that either own an annuity, are thinking about owning an annuity, or have been presented an annuity and they truly don't understand them. And really, they're very confusing. And I'm going to tell you the truth, they're one of the most confusing topics out there. So welcome to the Retire-tastic Show. And I'm your host, Joanne Regan. And today, the goal is to clear up some of that confusion. I'm sure you listen to other radio shows. Matter of fact, I have tons of my own clients who listen to radio shows. And I'm just going to give you a little background, a little disclosure, and make sure that you understand that when you listen to the radio, I know that you're doing it so that you can keep abreast of what's going on. The radio is an important source of information, but there's always going to be two sides to what the people are presenting. And that's why I say there's going to be those who think that everything has to be market-based only, and they hate annuities. Or there's going to be those who think that annuities are the only way to go, and they hate the market. Well, I feel like there's definitely two sides to this story and two sides to how things should work. And we're going to talk about that today. So as a disclosure here, I do want to say that I don't think that anybody should have all of their money in a single investment. I do feel like diversification across different types of asset classes is super important to having a well and balanced retirement portfolio. And so while we are still talking about annuities on today's show, I do want you to understand that I'm not telling you this so that you're going to go out and put all of your money in an annuity. That is not what I'm trying to say. What I'm just trying to say that there is a place for annuities in your portfolio if you understand them and if they can meet your needs. So I guess the main point I want to get across, it's like anything. Every single investment out there has pros and cons to it. For example, if you buy shares in ETFs, exchange-traded funds, that's linked to the S&P, you think, how possibly could that have cons? Well, talk to somebody that was 72 years old and had 80% of their money in ETFs in 2008, and they will certainly tell you the cons of that. So everything has its pros and cons. But what I want to do today is I want to talk about the different types of annuities and how they work. And I kind of want to set the stage a little bit before I go too far down this path and tell you some of the problems with annuity sales today. So in my opinion, one of the main reasons that annuities have a bad name is there are certain kinds of annuities that actually deserve a bad name, but it really has to do with the sales of the products. Advisors are using them in such a way to where they can kind of set it and forget it and not manage the money. In other words, I call them the one-hit wonder. They get paid a commission up front, and if people put $1 million, a percentage of that is going to go to the advisor. So you can see why some advisors do promote them. I think the advisor is promoting them from a standpoint that it's best in your portfolio, and that's a different animal, that type of advisor. It's nothing wrong with an advisor getting paid. One thing I will preface, if the advisor is getting paid, it actually never comes out of your account, and it doesn't cost you any money. So if you were to put $1 million in annuity, $1 million of your money is actually going to go to work. So don't think it's going to cost you a percentage of your money to pay a commission to advisor. No, I was actually going to get to another thing called surrender charge here in a minute. And it's one of the reasons annuities have surrender charges is because they upfront money to the advisor in the form of a commission. And so unfortunately, because of that upfront commission, many advisors are running paycheck to paycheck, and they promote the annuity too much because they want that upfront paycheck. You've heard me talk on past shows how advisors are morphing into a business model that's just a business model where it's more important than the consumer. And we want something that's easy to work with. Well, again, annuities are kind of a set and forget it, and they don't require a lot of management. So it's easy for an advisor to get out of managing that money or even other parts of your money. The biggest thing with these, and the point that I want to get across, there are certain ones you have to stay away from. And no matter what you do, you don't want to overdo it in an annuity. And I'm going to talk to you here in a minute about some of the guidelines that the regulatory bodies want advisors to follow. And I'm going to be talking about some topics and some aspects of a kind of a complex product. And I know you're not going to get it all on the first listen. So I have a commission report that I'm 100% sure that you're going to find helpful. And you can get this free report, which is called The Negative Spin on Annuities, by calling me at 1-800-FSG-7890. Again, 1-800-374-7890, and ask for that report by name called The Negative Spin on Annuities. So what I want to do now is I want to break down the types of annuities that there are. And technically, there are 4 different types. If you go on the internet and you start researching, you're going to see that they say there's only 3, but there are technically 4. The first type of an annuity is the single premium immediate annuity. And it's the oldest type of annuity that dates back to the 1800s. And I was actually sitting with someone in the office just the other day, and I was telling them how a SPIA works. That's what we call a single premium immediate annuity, a SPIA. And so you give the insurance company a lump sum of money, and they give you income for life. Now, one of the negative things and some of the bad rap that a SPIA might get is some of them are a life-only product. So if you give the insurance company a lump sum of money and you die prematurely, the insurance company can keep your money. But there's also other SPIAs that have a period certain attached to them. So you give them a lump sum of money and they guarantee that they'll pay out a payment for a minimum of, say, 10 years instead of just life. That way, if you die prematurely, your family will get some of the money back. But let's go back to the immediate annuity where it's a life only. So my client that was in my office, his immediate response was, "Isn't that how a pension works?" And I said, that's exactly how a pension works. So people that think SPIAs are horrible, who in the world would want their money kept on death? Well, that's actually how Social Security works. Ironically, there isn't any difference between a SPIA and Social Security. In fact, if you look up the term that they call your full retirement income, it's called your PIA, your primary insurance amount. Social Security is actually just a big SPIA. So a single premium immediate annuity is where you give the insurance company a lump sum of money, you get a lifetime payment. Even you could even set it up upon your death that your spouse would continue to get a payment, or you can set it up for a period certain where it pays for a certain number of years if you die prematurely. But the bottom line is the insurance company is going to give you a lifetime income for as long as you live. So the first type of annuity, again, is a SPIA. The second type of an annuity is called a variable. And I don't really think you should call them variable annuities. I think you should call them terrible annuities. I don't actually know why these are able to be marketed to the American consumer today. Now, again, I don't want to throw a bunch of one-size-fits-all statements out there. So let me go back and say, if you have a variable annuity and it was sold to you in the late 1990s or even early 2000s, you probably have a very good product because the insurance company back then, they were putting together great variable products. But here's what happened. And I don't want to get too far off track because I want to get into the 4 types of annuities. But the variable companies were putting a lot of benefits on these. Living income benefit riders. They were putting on these different types of life insurance riders and all of this stuff. And so then what happens is these variable annuities started accumulating a tons of fees. And these fees started overriding what you were actually getting from the variable annuity in profitability. And because variable annuities are directly in the market, here you are paying all these fees, and in addition, if the market went down, you lost your money. So not really the best investment for the majority of retirement age clients, unless, like I said, you bought one of these products in the early 2000s or earlier, then they probably would have worked for you. But the newer ones today, they're just not as great for my clients or great for retirement-minded people as they used to be. And I would like to say that if you're in a variable annuity that has a lot of high fees, why don't you give me a call and let me see what we can do to help you get out of that. Call me at 1-800-FSG-7890. So we've talked about a SPIA and we've talked about a variable annuity. The third type of an annuity is an equity indexed annuity or a fixed indexed annuity. And I'm going to talk about those in just a little bit. And the final annuity is called a fixed annuity. By far and away, the fixed annuity is the easiest one to understand. So when I come back from the break, we're going to talk a little bit about fixed indexed annuities and fixed annuities. Be right back.
Have you missed any of today's program? No problem. You can hear all of the Retire-tastic Show online anytime, 24/7 at yourfsg.com. That's YOURFSG.com. Welcome back to the Retire-tastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
So today on the show, we've been talking about Annuities 101. There are 4 types of annuities. So the first type was a SPIA, single premium immediate annuity. The second type was a variable annuity. And now I'm going to be talking about what a fixed annuity is. So welcome back to the Retire-tastic Show, and I'm your host, Joanne Regan. And so we're going to clear up some of those misconceptions about annuities. Let's talk right now about fixed annuities and how they work. Let's say that you have $500,000 sitting in the bank, and this is retirement money. And let me tell you something, you're probably really frustrated right now. First thing you're frustrated with is the measly rate of return that you're getting on your money. It's an insult. And you're frustrated with something else. You're frustrated with the fact that inflation is at 5.5%, and you aren't even getting 0.5% on your money. And this is your retirement money. So you understand on $100,000, you're losing about $5,000 a year to inflation. And that $5,000 a year equates to about $400 a month. Who can get excited about that? And it's not doing anything at all. It's not doing anything for you. It's just sitting there. It isn't keeping up with inflation. And you tell me, how would you like on that money that's put away for retirement for a 3-year term to get maybe 2.4%? That doesn't sound so bad right now, actually. And I do a lot of that. That's a fixed annuity. You can get a 3-year fixed annuity right now at 2.4%. So how does that type of an annuity work? It's very comparable to a CD. A CD is issued by the bank, and a fixed annuity, which is a multi-year guaranteed annuity, is issued by an insurance company. They're both safe, and they both guarantee you a rate of return. So this is not for fighting inflation because inflation is double that. And it's not for some 30-year-old looking for a long-term retirement planning. This is for the retiree that has $100,000 sitting in the bank earning less than 0.1%. And why not get 2.4? That would be such a better return on your money. And that's what a fixed annuity is. And that's what I'm saying. 3 years and you're out. There aren't any bells and whistles. There aren't any catches or gotchas. It's simple. So that's what I've been trying to say. Not all annuities are hard to understand, and they're not all bad. I know I'm covering a lot of information in a really short period of time, and I know you're not going to catch it all because it is a lot to take in. So that's why I have a commission report that I'm sure you're going to find useful, and it's called The Case for Fixed Income. Ask for it by name. Give me a call at 1-800-FSG-7890 and ask for the commission report called The Case for Fixed Income. All right, so now the next annuity that I want to talk about is a fixed indexed annuity. And like I said, with inflation creeping up and the market kind of getting out there and being a little crazy, sometimes we're all sitting here thinking, okay, well, should I pull all of my money out of the market and put it in the bank earning that 0.1% and give up a whole bunch of income that may or may not be necessary to do, but you don't want to lose money? Or is there an alternative? So equity indexed annuities are a really interesting product, and I like them. I'm not going to lie, I like them a lot. And why? Because if you pick the right one and if they're used properly, they're a great competitor to bank accounts and government bonds. First of all, if you're looking at or if you have owned an equity indexed annuity, understand that these things are not meant to compete with the market. One of the problems I think the insurance industry has created in the last decade is that it has come back to bite them, is that they've sold these things like they're in competition to a S&P 500 fund. No, they're not. You're never going to make the money in an indexed annuity that you could make in the market, but there's a pro side to that. You're never going to lose the money in an equity indexed annuity that you could lose in the market. You just have to understand that they're not the same. The market and an equity indexed annuity are not the same, but they are meant to give you, the consumer, a 3 to 6% return, averaging 4 or 5% over a long period of time with virtually zero risk. You heard me right, zero risk. So in the space of an ultra-conservative investments, this is a great one. You only have maybe 3 or 4 options out there if you want to be really ultra-conservative. One is bank accounts and CDs, which pay nothing, government bonds, which currently are paying nothing, fixed annuities, which are right around 2 to 3%, and then you have your equity indexed annuities. And when you look at all the competition out there in the annuity market or in the other markets, right now, indexed annuities are blowing away the competition. And again, you can get a good solid rate of return. They are linked to the stock market index, but they are not actually directly invested in the market. So if the market goes up, you make a percentage of what the market does. And if the market goes down, you don't lose any money. So there are years where you might see zero income, but I'm going to tell you straight up, I've had clients that have made more money in their equity indexed annuity than they did in their market accounts because the market dropped and they lost a whole bunch of money. And the good thing is the money in their equity indexed annuity never went down. So it's really an awesome place for someone to consider putting a portion of their retirement income if they're looking for a safe investment. Another thing that I really want to point out is equity indexed annuities are basically a version of a fixed annuity product, and they do have a good return, but really annuities have one primary job, and that is to create income. Matter of fact, I had a discussion with the president of one of the major carriers, and I told him, I think that's something that the insurance industry has really gotten away from. Back in the 1880s, when they created annuities, they were built for income, and they're still built for income. It's kind of like trying to take a truck and make it something that could compete in the Indy 500. Well, it's just not. No matter how you slice and dice an annuity, you can paint them up and pretty them up and all that stuff, but they are actually built for income. So if you find yourself wanting lifetime income with virtually zero risk, an annuity is not a bad approach to get it, especially an equity indexed annuity. But again, you don't want to have all your money in any one product. You find yourself in a situation where you recently purchased one of these, or your advisor is maybe showing one of these and you want to know more about it from an unbiased source, well, just simply pick up the phone and call my number, and I'll get you a commission report called The Negative Spin on Annuities, and you can call me at 1-800-FSG-7890. That report is absolutely free with no obligation, and that way you're going to feel more educated after reading that report. So I'm trying to clear up this rather confusing topic of annuities, and I guarantee almost everybody here has either been shown one or potentially own ones. And now I mentioned earlier that I would get into the problems with annuities so that you can understand the pros and the cons. So the first thing that I want to mention is that the insurance companies that you do business with are as safe as a bank. There has never been a dollar lost in annuities due to a company failure. And that's one of the main reasons people buy them. Second, they're working as a decent bond replacement. But as I said earlier, this is a temporary fix because bond rates are eventually going to go back up. And when they do, then they're not going to be as competitive. But having virtually no downside risk, if you get the right type of annuity, then that's going to be way better than the banks. Because the banks are paying 0.1%, and you can get much higher rates of returns on annuities right now. One of the other things, if it's non-IRA money, you can get tax deferral just like it would be if it was IRA. So money that goes into an annuity, if it's non-IRA money, that money grows tax deferred, meaning you don't have to pay tax on anything until you take the money out. And that's definitely a pro. But let's talk about the cons. So one of the cons is the surrender charges. So there is a surrender charge when you put your money in. The surrender charge could be anywhere from 3 years to 10 years, depending on the life of your annuity product. And the surrender charges are basically kind of like a CD. If you put your money in a CD and you take your money out early, you're going to pay surrender charges. And so that's kind of one of the things that is part of an annuity. There's also another thing in annuities called a market value adjustment. So basically with a market value adjustment, if you bought an annuity, fixed variable equity index, anything like that 3 or 4 years ago, you probably have that market value adjustment as part of your annuity product. So what it is that it's an adjustment that you could have a positive market value adjustment or a negative market value adjustment, depending on what interest rates are when the annuity company bought your product for you. So if you were to cash out of that annuity and you have a positive market value adjustment, great. That means you might be able to get out of it early if you wanted to. But let me just tell you, annuities do have a place in a retired person's portfolios. They can give you lifetime income. They can give you better rates than the banks are giving you right now, but they are not designed to compete with the market. They're a completely different product, but they do have a place in many people's portfolios. So if you're interested in that commission report that I had, the case for fixed income or the negative spin on annuities, either one of them, give me a call at 1-800-FSG-7890, and I'll get those right out to you. Well, that's all the time I have for today, and I appreciate you listening, and I really hope you've learned something about annuities. And if you like what you hear, please tell a friend about me. If you have questions, I have answers. I'm here for you. Give me a quick call. I look forward to speaking with you off the air. Have a great week.
That's all the time we have for today. To speak with Joanne off the air, call 800-FSG-7890. And for more information about our program, visit yourfsg.com. The Retire-tastic Show with Joanne Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. To speak with Joanne off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com.
Investment advisory services offered by FSG Financial Services, Inc., a registered investment advisory firm in the states of Arizona, Nevada, and California. Sound Income Strategies, LLC, an SEC-registered investment advisory firm, is a sub-advisor of FSG Financial Services, Inc. FSG Financial Services, Inc. and Sound Income Strategies, LLC are not associated entities. FSG is a franchisee of the Retirement Income Store. The Retirement Income Store and Sound Income Strategies, LLC are associated entities.